everyone, I'm Shivang Mehta. In this session, we are going to analyze IDFC Fixed Term Plan Series 196. NFO of this fund will be opening on 15th of March and closing on 21st of March. So if you are an investor who has low to moderate risk appetite, then this fund is for you. So let's go ahead and know about this fund in detail. Before we get to that, please subscribe your YouTube channel for analysis of new bonds, NFO, NCD, IPO, ETF, and many more. Also visit yourShops.com and use coupon code YO100 for flat rupees 100 discount on all products and free 1-year GST and ITR e-filing services. So what is fixed maturity plan? Fixed term refers to a financial instrument in which an investor's funds are locked for a predetermined period of time. Investors are paid back their principal at the end of this period. Example of fixed terms include term deposits and bonds. So fixed tenure mutual fund scheme that invests its corpus in debt instruments maturing in line with tenure of the scheme is called fixed maturity plan. So coming to the details of IDFC Fixed Term Plan Series 196. So it is a close-ended scheme with tenure of 365 days with relatively low interest rate risk and relatively low credit risk. So objectives of the scheme seeks to generate income by investing in portfolio of debt and money market instruments maturing on or before the maturity of the scheme. So asset allocation will be 100% to debt and money market instruments with the risk profile of low to medium. Investment strategy of the scheme. So the aim of the investor management will be manager will be to allocate the assets of the scheme between various money market and fixed income securities with the objective of achieving optimal returns with highly liquid portfolio. The actual percentage of investment in various fixed income securities will be decided after considering the prevailing political conditions, the economic environment, the performance of corporate sector, and general liquidity and other considerations in the economy and markets. So coming to the plan, so there are 3 or 4 types of plan: direct plan, regular plan. These are all general plans. Direct plan, you can directly, invest with the fund house. Regular plan is with through an agent. Options available under the plan are income distribution, come capital withdrawal plan. In this, time to time, you will get an amount in your account like a regular income, and default option will be direct plan. Instruments will be instruments in money market instruments in which the this proceeds of this new fund will be invested are corporate deposits, corporate papers, NCD, treasury bills of government, cash management bills, GSEC or CPLO. These are all money market instruments, and company will opt for AAA or A1 plus rated securities. Coming to the benchmark application, fund manager and load factor. So the minimum application amount will be rupees 5,000, and after that in the multiple of rupees 10, benchmark will be Nifty low duration debt index. So we will be also see performance of this index as well. And fund manager is Harshil Joshi, and name of the trustee company is IDFC Asset Management Company Trustee Company Limited. Performance of the scheme does not have any performance track record, and entry load and exit load is nil. So benchmark performance. So benchmark of this fund is Nifty low duration debt index. So in 1 year returns, if you see, this index is given 4.1% return in last 1 year. So we can consider the liquidity situation all over the world. So this debt instrument is not able to generate the amount of returns it should generate to beat inflation or the fixed deposits. If we see other benchmarks as well, like Nifty liquidity index, ultra short term debt index, the only outperforming index is Nifty credit risk bond index. So in this, as you know, the risk of debt increases, so it has generated 8 to 9% returns. But benchmark for this scheme as of now in last 1 year has generated 4% return, and since inception it has given 7 to 8% return. But considering the future, monetary policy tightening, situation could be different. Debt indices, as we have seen in previous slide, you can make out the performances. So there are outperformance are Nifty ultra short duration debt funds and The Nifty low duration debt index has been a moderate performer over the years. Opportunities. So when you invest in a fixed maturity plan, there is indexation benefits. So you only have to pay taxes after deducting the inflation of that period. So mutual fund investors have the option of paying capital gain tax at 10.3% without indexation or 20.6% with indexation. Gains from secondly, the gains from fluctuation in interest rate during the tenure of the firm. So since there is monetary policy tightening and there is increasing in the yields of the bonds and other fixed income securities, you might be gaining from the fluctuation in interest rate in medium term. Risk of capital loss is negligible as fund house invest in highly rated schemes. So this is self-explanatory. Stability, since fixed maturity plans are locked in for a particular duration, your investment goes through both markets ups and downs. So this will have the performance of this fund stabilize over the time. FMPs are also, to be the least affected investments by the market movements, since they are, you know, and lastly, long-term capital accumulation. If you want to create a long-term capital accumulation and you don't want to incur expenses, or you have appetite to incur expenses, but also have a goal to accumulate a capital, then you can go ahead with this, fund. Risks, so price risk or interest rate risks. Fixed income securities such as bank CD run price risks or interest rate risk. Generally, when interest rate rise, price of existing fixed income securities fall, and when interest rates drops, such prices increase. To the extent of fall or increase in the function of existing coupon days to maturity, and also increase to decrease in the level of interest rates. Reinvestment risk. Investment in fixed income securities may carry reinvestment risk, as interest rates prevailing on the interest or maturity due dates may differ from the original coupon of the bond. Basic risk, interest rate movement, as we have seen in previous slides. Spread risk. In a floating rate security, the coupon is expressed in terms of spread or markup over the benchmark rates. However, depending upon the market condition, the spreads may move adversely or favorably, leading to the fluctuation in NAV. Liquidity risk. So, due to the evolving nature of the floating rate market, there may be increased risk of liquidity risk in the portfolio from time to time. So, the most fundamental question is, should you invest in the scheme or not? So, considering monetary policy tightening by central banks, interest rates are expected to remain elevated in medium term. Therefore, investors with excess liquidity can take advantage of interest rate fluctuation by investing in this firm. So, scheme is suitable for those investors who do not have a risk appetite to invest in equity market, but wish to take advantage of interest rate fluctuations in money market. Leveraging is not advisable due to geopolitical tensions hampering world economy on daily basis. So it increases your risk and put you in the high risk category. So now you should consider your long term wealth creation vision and risk appetite, and should plan to invest in this NFO. Thank you.